Hey traders, Raghee here, and in this recap video we're going to talk about the sell-off in the S&P, and we're going to go through it from the standpoint of, one, how do you know when these volatility events are going to occur? And now, with the understanding that we continue to trade in a much higher than normal daily and hourly price movement range, it's still 2x, 3x, sometimes 5x intraday. It's sometimes over 2x the end of day. We're still in that heightened volatility. How do you choose time frames? What are the tactics we have to use? And remember, this shift is a relatively new shift. We had Monday's meltdown just over a week ago on the 5th. So this is a relatively new shift in terms of understanding and accepting that we are now in this elevated price movement range environment for more than just a day or two, but now continuing for over a week. So looking at the ES, so first of all, the economic event was an 8:30 hot zone. And that hot zone was the CPI, as you can see here, and core CPI. Now, to look at a number like this or this, I don't know that anyone would look at that and say, okay, now here we go, elevated volatility. I don't think that was it at all. In fact, I'll say, do this. I look at the time, I look at the event, and I look at the expected impact, and that's all I need to know. I'm really not all that interested in any of this till much, much later. All I know is that 8:30 has the potential to really move the markets, and from the inflation standpoint, which means I also know it's going to affect the futures index contracts, dollar, gold, and then any of those contracts that kind of fall from there, the bonds, euro, etc. So I've got a pretty good watch list based upon the kind of impact that I would expect as the market digests the news at 8:30 Eastern. This news was very dramatic, far more than I'd say typical CPI numbers would trigger, but this is also a different market ever since the 5th. And again, we've had now about a week to accept that we're in this heightened volatility, heightened price movement range environment. Within 180 seconds, this market sold off over 40 points. Your normal price movement range for the for the ES contract, the E-mini S&P 500, is nowhere near that. In fact, your typical hourly price movement range is approximately, I'm going to show you right now, your typical hourly price movement range is about 9 to 12 points, and now your typical daily price movement range is upwards of 32. We blew that out of the water in 180 seconds, not a full session, in just 180 seconds. So that shows you still how full tilt this market is, but it's not untradeable if you start looking at two things. One, very short-term time frames and where they lead you. So the first thing is, think about how the market was setting up before the event. We actually had two Darvis levels basically showing us that the market was bouncing around in this area. Now, I will tell you, even if you had a buy stop in this area, it happened very quickly. Would you have gotten in? Yeah, I think you would have gotten your short sell that triggered somewhere in this area with some slippage. But you would have gotten it as the market sliced down through approximately 26.68, 26.69. But what if you did not have a sell stop? What if you did not have a sell stop waiting here because you were bracketing this market? I mean, it's the only way you would have had a sell stop waiting here, because you were noticing the range and that you had the proactive sell stop order. A lot of people will then trigger a trade in the downtrend or on this one doji on the 1-minute chart, which is fine. The old market would have likely have exhausted somewhere around here, maybe, about 7 to maybe 10 points in. Now we got 4x that move, and that's number one why a lot of intraday traders are able to play momentum with so much higher follow through and success. The market continued lower. Now, you might say, well, Rog, I didn't do any of those things. I didn't have a sell stop here. I didn't short this doji, and I wasn't expecting a 4x move. And my response is, probably most people did not. They just followed the momentum until it stopped. Here's where it gets interesting. I'm by nature a slightly longer term trader. So looking at something like this on a 1 minute isn't my natural tendency. But looking at where the intraday takes us down to this oversold zone, and again, this is based on Darvis levels, so it's pre-identified. I'm not having to make a decision on this level being oversold at the moment of the sell-off. I'm looking at it as the market sells off with the 1 minute chart. So I know this is oversold. The 1 minute has let us down here, and I know that as we cross back up 2640, or as we sink into the area between 2630 and 2640, we're likely to find what? Find support. Well, let's take a look. If you were not buying that zone, you were uncomfortable with the speed of the market, that's fine. You know, this would be an oversold buy, but let's say you were uncomfortable with that. So then you go back to that 1 minute and you say, well, 1 minute, give me some guidance here. Where is the shift in the sentiment occurring? Using the grab candles and the wave, you actually were able to identify where the shift happened. And that's what I'm talking about, thinking more like a day trader. And these are the kind of tactics we're going to talk a whole lot more about next week. I'm actually leaving for London tomorrow evening. I'll be back. I'll be flying back on President's Day. So I'll be back in the room with you all on Tuesday. The room will be closed on Monday, and I will see you all then. But this is the kind of stuff we're going to be talking about going into next week. Heightened price movement ranges, how to use the tops indicators on short-term time frames. In other words, all the things that I've been teaching, for example, trend following the Euro US for a 1,200 point pip rally. How do I take those exact same tools and intraday trade the S&P and fade the 60-minute S&P? Same tools, different market trend, but I think you're going to love the way these dovetail really nicely with strategies that you're probably already familiar with, because I've been teaching them in the Simpler Future site, and also a lot in these recap videos. All right, hope that was helpful. I'll see you in the next video.